Hello, everyone, and welcome to another Top Agent Nation Commercial Wednesdays. Very great topic, interesting topic. As we all know that our commercial practitioners, the 1031 exchange, right? We don't want to pay taxes. We want to keep exchanging. But also, if you don't get to find your replacement property, you need to look for alternatives. And the DST, I've used it before. I know I did this with Tommy, but many people are looking for it if they want just a clip a coupon, get a return, find a way to exchange their product into something that maybe suits themselves. They don't want to clean toilets or open up locks, but they want to look for something with upsides and yields and returns. So it really is a balance. And we have three experts here today to really go in deep about the 1031 exchange, their companies, and also what's going on in the market. And we will, yes, talk about how the tariff are affecting everyone and everything that's happening, because we thought we got through the election and maybe some interest rate stability, and now we have something new popping up like this. So one, I'll give Justin. I know a lot of things feeds through you with JTC America and also the accommodators, but if you don't mind sharing your background experience and a little bit about your company.
Yeah, no, thank you. Thank you very much for having us, Jim. So JTC, we're a nationwide and global qualified intermediary. JTC is a global company with 23 global offices, and we've been in the exchange business for 20 years now. Crazy to think about. We're a tech company with a financial services background. We develop purpose-built technological solutions to streamline the administrative requirements for these specialty types of transactions like 1031 exchanges. And we work in different markets, both in opportunity zones, private equity, but my job is maintaining the day-to-day responsibilities, working with real estate professionals, financial professionals, and DST sponsors, providing our end-to-end technological solution to streamline that exchange process.
Justin, thank you so much. Alex, if you don't mind sharing with Kingsbarn.
Yeah, certainly. Thanks for hosting and having us on today. Kingsbarn's a private equity sponsor. We sponsor mostly DSTs, as well as do some other real estate investments, including our private placements, value add type of transactions, as well as ground up development. Right now, we have about $2 billion of assets under management. We've placed about $1 billion of DST equity and have about 1,000 investors within our DST program. And so with our DSTs, we're looking for stabilized assets that are, institutional quality, that provide our investors a great return without management responsibilities, similar to what you had said, James. So we have been around for 10 years now, and we are excited to see what the new administration brings in form of new economic policy and everything else.
Thank you, Alex. And also Tommy Thompson, with Fortitude Investments. Very interesting,
Guys.
Tommy. So I know you see a lot of things going on too, speaking around about 1031 exchange, if you don't mind sharing your background and your company.
Yeah, I'm with Fortitude Investment Group. Fortitude was founded by Dan Raup, Jeffrey Koznowski. Dan Raup is the record holder for the largest Delaware Statutory Trust ever completed. He did a $176 million deal back in 2017 for a large family up out of the Northeast. So it's the largest 1031 DST transaction ever performed. We're really proud about that. But, we do $50,000 1031 exchanges all the way up to the largest and most complex ones, ever performed. So it's really our bread and butter. We're a private wealth management firm. We don't just specialize in DSTs. It is kind of the main thing that we're working on constantly. But we also provide passive real estate investments for our clients. So we build passive real estate portfolios. That could be across ground up development projects with quality sponsor companies. It could be private real estate acquisition funds, buying $500 million of, data centers or industrial buildings. And you can, tap into that with cash or qualified fund proceeds for as little as $50,000 if you're an accredited investor. And we specialize in real estate. So everything we do is going to be real estate focused. We're constantly working on 1031 exchanges. And I go around and I preach about the baby boomer exit. So a lot of people, exiting out of real estate, they don't want to manage properties anymore. They don't want to pay taxes, and they want to be more passive in the process. So that's what I talk a lot about. I've worked a lot with Justin Amos over the years. And of course, you, Jim, appreciate you doing, some business with us over the years and your family. But yeah, happy to be here. Thank you, guys.
Tommy, I'm glad you brought that up, because obviously the 1031 exchange, we all know, is it going to be here? Is it not going to be here? Right? It kind of scares us a lot of times because that's a whole industry. But there's also the evolution. I remember we all went to what is DISA, the 1031 exchange and kind of DST sponsors event. And I remember I was back in the day when it was ticks. Right now, a bad word. We don't like to call it ticks anymore, back in the 90s. But, the kind of the evolution, and I'll throw this to you, Justin, because your company wasn't publicly traded. How was the evolution that you've seen from the exchange, and obviously the ups and downs, and really why, and this will be open to everyone, why should we fight for keeping the exchange going and not having these discussions ever so often when I think financial crisis or different things, and maybe, not being political, Trump understands real estate, so maybe he won't get rid of it because I'm sure he used the exchange before. But if you don't mind sharing a little bit about what the 1031 is, and also, how has it changed and why should we fight for it?
Yeah, no, thanks, Jim. No, well, to go in on what is a 1031 exchange, it's a method of selling real estate, an investment real estate for no gain or loss, per section 1031. It can enable you to defer those capital gains and depreciation recapture taxes on that transaction. Seeing the evolution in the exchange. As when Trump originally was president, and the Tax Jobs and Cuts Act came out, eliminating personal property to be allowed in the exchange to focus specifically on real estate back in 2017. What I've seen over the last 7 to 8 years since that first iteration of evolution is I've seen the market and institutional investors starting to be more acceptable. We're starting to see 1031 products, large investment REITs starting to get into this space as they look to diversify their portfolio and seeing how they can attract the tax advantage as an alternative to traditional real estate like DSTs. Passive, we're seeing a growth in the passive ownership of real estate, and also different asset class types that normally people wouldn't be able to invest into are now starting to be able to take advantage of that through these programs that these large investment companies like King Barn and others produce for products for the market.
Yeah, and watching the evolution, I know, Tommy, you've been kind of advocating, talking, sharing. Can you add to this and maybe some of the strategies you share with your investors? Obviously you are a platform with different DSTs, different exchange products. So you have a variety of different things on your platform. So what do you share with your clients, especially on the 1031, educating from the unsophisticated to now, as Justin said, pretty sophisticated investors now using the DST for strategy?
Yeah, and just to piggyback on, what Justin's talking about too, the 1031's been around for over 100 years, as a part of the tax code. So it's something to fight for. I always talk about that it's a great tool for, recycling commercial real estate, helping people exit in a tax efficient way, right? If you sell an investment property, you exchange those proceeds into another investment property, and you can defer those taxes. So older investors that own properties don't necessarily want to do, the improvements on those properties. They can sell that and exchange into something else, so somebody else can step into that property and, do what needs to be done. It's a really great recycling tool, for the market, right? It's a way of keeping commercial real estate strong, in my opinion. But yeah, DSTs, it's not as complicated as you think it is. I always use the analogy, it's like owning a slice of the pizza of a larger, institutional asset, right? So, just think of a brand new construction Amazon distribution center, might be 1 million square foot distribution center, cost $100 million to purchase that property. Not all retail investors can go out there and buy $100 million property, but they want a tenant like Amazon. These large institutional sponsor companies will go out, purchase that property, and then you can buy a slice of the pizza for as little as $100,000 of that property using your 1031 exchange proceeds. And, I call it kind of the cruise ship of real estate ownership, right? You're completely passive. It's the most passive form of real estate ownership, in my opinion. It is for accredited investors only. If you're not familiar with what that term means, you can either have a $1 million minimum net worth, excluding your primary residence. So tally up your entire financial picture, inclusive of your investment real estate assets, the value of those. If all that adds up to $1 million or more, then you would qualify. Or if you make $200,000 in income in each of the last 2 calendar years, filing single, or $300,000 in income in each of the last 2 calendar years filing jointly as a married couple. If you hit one of those, then you would qualify to be able to invest in one of these programs. Our menu ranges between 25 and 35 different DST programs, ranging across all different sponsors, asset classes, self-storage, multifamily is the most popular one, industrial, net lease, pretty much everything across the board. And when an investor comes in and is looking for a replacement property, we just kind of go through the process with them, find out what their wants and needs are, income, growth, appreciation, or all of those things. And then we just turn the dial and select different DSTs that kind of line up with their investment goals. We get all those set up prior to their closing, and then once they enter into their 1031 exchange, using JTC or a qualified intermediary, those proceeds get wired to each one of those different investments, and you can be turned around, invested in those programs within a week and a half, typically pretty quick turnaround time, and in the dirt, prorated cash flowing for that month, and kind of ride off into the sunset into those DST programs and become passive.
Tommy, thank you. And Alex, I know with you at Kingsbarn, you are one of the sponsors. So with this, watching these changes of 1031 exchange to what are you seeing too right now in this market that clients are looking to, or are they just delaying everything? So can you kind of share with what you're seeing with clients and the exchange programs?
That for the last year, 2, 3 years, there's been some uncertainty in the market, as we all know. And so there's been some folks that have just decided to pay their taxes and finally get out. But there are a lot of folks that have been at 1031 and deferring for their entire investment career. And so, it could be upwards of 40 years. And so a lot of those folks don't want to have to pay their capital gains taxes and all the depreciation recapture that they'd have to. So there's folks that are continuing to 1031, and DSTs have been a primary and a perfect landing spot for the demographic that's been exchanging for 40 plus years and is tired of actively managing their properties. And the DST allows them to get in with a piece of real estate that has an investment grade tenant that's institutional quality. They don't have to worry about any management and get to basically collect what we like to call mailbox money. And that's been the primary driver for our business and our growth for the last 10 years at Kingsbarn. With the uncertainty, there has been the select few that have decided to just say, I'm gonna cut my losses and just get out of the market, wait for other opportunities that present themselves, especially when interest rates were high and values were actually starting to come down a little bit. With what we're seeing right now in the stock market, though, we're seeing a lot of uncertainty. The S&P, I think, has been down for the last 5 or so days straight. That actually presents a great opportunity for real estate because when you're looking for alternative investments outside of the stock market, real estate, I think, is a prime opportunity for somebody to get in and start to actively own and have their investments and money working for them, rather than seeing that value come down with the market. With DSTs, it's a securities offering, and you can take that money out of the stock market. You're not able to 1031 exchange, but you're able to plug that into a $100,000 investment into a Tesla, an Amazon, or what have you, maybe a nice quality student housing project. And so I think we're going to continue to see a lot of that, especially with the stock market uncertainty that we're seeing now.
Alex, I'm glad you brought that up. Yeah, with the volatility, real estate still is something you can touch, right? And it's tangible. There is tax write-off. There is a return a lot of times. So, it is a good one. And now alternative investments, right? I think with crypto and everything, they dump real estate into alternative investments, even though it's a large asset class. So at Kingsbarn, do you look at, because I know you have a DST, but also you have a private equity group. Can you share the advantages of having kind of that publicly traded entity, but also your private equity and how that goes back and forth? And then Tommy, we'll talk later maybe about the UPREIT, right? The exchange with the 721. So Alex, can you share how does it work holistically now that you have kind of both sides?
Yeah, certainly.
Strategy.
Yeah, there's the all the advantages that you get at the DST is primarily the 1031 exchange and the deferral of your capital gains taxes. For those that may be exiting the stock market, as I had mentioned, they already had to pay their capital gains taxes. And what they may want to do is say, hey, I'd rather not plug into a DST, which has I would say moderate appreciation growth over the long term, but you get that current income that a lot of our investors need. They need that supplemental income that a DST provides. But for folks that just have had their money in the stock market that are looking for other opportunities for that equity growth, our private placements, our private equity group is particularly looking at inefficiencies in the market and where we can find the best value. And sometimes being the contrarian is I think a great mindset to have when you're in real estate. So what we've actually looked at is finding what are some asset classes that the rest of the investment world is kind of putting on the back burner, is not looking at, and what are we able to pick up at a good price. And we've actually been focusing a few opportunities on commercial and office space right now, mostly in high quality markets that have that opportunity for value add. And we've acquired a few projects within the Orange County area where we're looking at continuing to acquire more assets in that market that have reduced rents, or maybe there's a lot of opportunity for us to get in and get our hands dirty with a good business plan. And buying it cheap is always what makes these properties work. So I think the common saying is you don't make money on the exit, you make money on the acquisition, right? And so we were able to buy an amazing quality property in Santa Ana, right off the 55 freeway. And it was, something that Blackstone actually had said, we're washing our hands of this asset. We don't really believe in office at the moment. And we said, great, we'll take it at a basis that you haven't seen since before the Great Recession in 2008. And so we were able to pick up our Griffin Towers at I think it was 86 million, which was around $146 a square foot, which is just unheard of for prime institutional quality office. And we've been able to get in there with our basis and outbid the rest of the market in Orange County to get new leases in. So we went from 50% rent roll occupancy to mid 80s and approaching 90%. And with that, we're able to provide our investors huge appreciation on their equity, which they wouldn't be able to get in the stock market right now. So we're continuing on with that business plan, as well as ground up developments. We've been developing a number of apartment complexes throughout the U.S., as well as doing some merchant build with some travel centers, actually with Travel Centers of America. And we are just opportunistic, and we don't mind going out and being a little bit contrarian or going after asset classes that the rest of the market's not touching. And that gives us an opportunity for a great exit and values.
Alex, and that's great, because one thing is with so many sponsors, and I'll have Tommy talk about, you get to see a bunch. It's almost like asset allocation. You're creating this, especially, we always said, you're a stock person, stock and bond person, or you're a real estate person, because you're just comfortable with those asset classes. And with the largest transfer of wealth happening now, a lot of times, I know we did this too, Tommy, with my family, is consolidating, making it easy before it gets too late. So a lot of times when we had estate planners, lawyers talking, setting it up, especially if you have a large amount to shelter, to protect it, to exchange it, right? You want to have all the pieces. And real estate really was one of the trickier ones, right? Everyone in the stocks, bonds, pretty liquid, pretty transparent, very transparent, right? You could just easily exchange. But in real estate, very complex, very, very hard to understand. And then obviously putting in a DST, oh my gosh, Tommy, with subscription agreements with my parents and stuff to go through it, it's not easy. So Tommy, can you share, because I know Fortitude, being a broker dealer with the platform, looking at all of these, can you just share with everyone, and I know you touched upon it, kind of the risk, returns, yield? You're almost, you are a financial advisor helping people asset allocate the right structure, the right mix, so they can, hopefully not outlive their wealth.
Yeah. And it was great working with you guys. And It was a lot of fun. And obviously you're, super sophisticated real estate investor. So we always love working with both sides of the coin. I mean, somebody who's brand new to real estate versus somebody who's really sophisticated. You can kind of dive into the materials and, do your own underwriting, which you were able to do, obviously, Jim. But, you saw our process. We're big on education. We have a great menu. We know our menu really well. And that's what sets, people like myself and, Alex apart from, maybe other people that are out there that say they have a DST, but they only have maybe one or two on their platform, at their wealth management firm. It's not what they do every day. These are complex products, and it's complex to invest into real estate. You have to do really thorough due diligence. None of this stuff is guaranteed, right? So it's all about doing your due diligence on this stuff. So that's why we always say it's so important. Like, I don't even care if it's with me, just work with a really professional, DST advisor that knows this product really well. Everything is totally different. Each one of these programs is completely different. So know what you're getting yourself into. But yeah, we have a really easy process. We get to know what somebody's goals are. Like with your family, it was different than somebody who might be 80 or 90 years old. You guys had different investment goals, and we went through all that stuff with you guys. But Alex brings up, a couple of great points there too. Where we're at in the cycle, a few years ago when cap rates are really compressed on the DST menu as well. It really reflects the commercial real estate market. It probably has like a 3 to 4 month difference to kind of catch up because it takes some time to package these deals and purchase them and close on them. But our DST menu really reflects cap rates, in the market, right? There's going to be fees associated with DSTs because it costs money to package these things and market them. And it's not cheap to do that type of stuff. So there are some fees associated with it. So maybe the cap rate is a little bit different than the cash on cash return on a DST menu, but you're getting that convenience of tapping into a really institutional type portfolio, and, having it be turnkey. But, Alex brings up some great points. There's some really great buying opportunities out there. We have a really strong DST menu right now. A lot of these sponsor companies can get much better institutional financing, than we can get going to the bank. So they're picking up deals from developers that had construction notes that they can't refi because the numbers aren't making sense. They're buying properties for, there's a lot of value out there in the market. So yeah, we have a really strong menu right now, but when it comes down to somebody's goals, like you talked about the 721, Jim, that's been a really hot topic over the last 3 or 4 years. 9 years ago when I was doing this, nobody ever talked about that. 721 exchanges have been around for a long time, and it's a way of getting into a REIT, directly into a REIT, right? So you can do a 1031 exchange into a DST, and then that DST can get bought by the parent company's private or public REIT and get 721 exchanged up into the REIT. So you're essentially getting absorbed up into the REIT and converting your ownership in that DST for operating units in the REIT, right? So it's a way of becoming really diversified because you can go from selling a strip center into a package of DSTs. One of those DSTs gets bought, and then you get absorbed up into $1 billion REIT. So you have hundreds of properties inside of that REIT then, and then you can liquidate your shares after that lockup period expires, which is typically a year or two, depending on the program. But it's a way of becoming liquid eventually, and we usually see it for older clients. We usually see it when clients come in and they say, "Hey, this is my last one. I don't want to continue to do this. I'm really doing this as an estate planning strategy, so that my heirs can get that step up in basis when I pass away, and then they're going to sell their shares, in that REIT." That's really where we're seeing that. It's not a big growth and appreciation play on something like that. It's going to be more kind of steady Eddie. So if you're looking for more of like a growth and appreciation play, maybe something Alex is doing or one of the other programs that we have on the menu that has that strategy in place, we call it the traditional DST, right? You buy into it, you sit in there for 5 to 7 years, kind of the average hold time for a program like that to see some appreciation and growth. That's kind of the historical for commercial real estate anyway. And then they look to sell that property for a profit, hopefully. Nothing's guaranteed, but historically, a lot of the sponsors have been able to do that. But yeah, it just depends. The UPREITs, you're going to be hearing a lot more about those, though. Those are not going anywhere. Those are just getting started. That's going to be a massive, massive play. A lot of these big players are entering the space, big names that everybody knows that has these big public and private REITs. And really, it's just good for the whole industry because the more that people get educated on stuff like this, the more people want to use programs like this and need, top level experts like all of us on the call here. So, it's kind of like free marketing, for us, but yeah, that's not going anywhere. The UpREIT strategy is just getting started. And with the whole baby boomer demographic exiting and the silent generation exiting, a lot of baby boomers built businesses. They own the laundromats, the plumbing and heating companies, the whatever, CPA firms, law firms, doctors' practices. A lot of those people are looking to exit soon. Their kids don't know the first thing about real estate. They don't want to do what mom or dad did. It's so weird. I hear this every day that the kids do not want to do what mom or dad did, and the kids are doctors, nurses, school teachers, whatever, but they're not real estate people. So it's actually more of a burden for them to inherit the real estate than something positive, which is weird for all of us on the line to think about because we're all real estate people. But a lot of people don't know how to do that. So there's a huge demand out there for these types of programs. And it's, in my opinion, it's just getting started.
Well, Tommy, and thank you, Alex and Justin, because it is why we're doing this. You don't know, you don't understand. And it really does start with the exchange, educating them, getting them in the pipeline, showing them that you don't always have to exchange into another product, because we know finding it is hard, right? And when people don't think they're going to get the return, they don't sell as much, right? So everyone pulls back. So it's very difficult. Or if it's a compressed market, a lot of bidders, now you're like, oh my gosh, I can't sell this because there's no way to exchange into something else. So it is important to get educated. That's why I like to do this. And all commercial agents, even residential too, they need to understand this, because they do encounter clients. And the worst, right, Justin, is to misstep, to miss the exchange, to do something and get it started and go, Justin, can I exchange now? It's like, how many times have you heard that, right? With an unsophisticated client or an agent, this is the worst, that gives them the wrong advice. So if you could share a little about the process, especially since you're the start of it.
Yeah, no, it's an unfortunate news when you get a call from an exchanger, especially if you've spoken to them previously, and they give you that call and like, oh, I'm ready to start the exchange now. Oh, great. Well, when did you sell? Oh, I closed 2 days ago. Oh, well, unfortunately, that's you've missed your misstep and you can't move forward with the programs. The funds at the time of sell, whether you're selling commercial or a single family home, have to go from the closing agent to the qualified intermediary. So what we'll do on behalf of our clients is set up a dedicated exchange account, so not commingled. And this account was tied specifically to the exchanger, and will hold the proceeds from that sale to the ultimate purchase of the replacement property. One of the things that we mentioned for our clients, both agents and exchangers, it's weird, as Tommy mentioned earlier, that even though the exchange has been in the tax code for well over 100 years, the role of the qualified intermediary is still an unregulated industry. Now, each qualified intermediary has their own set of rules and procedures and timings, and I guess people who work for them. So the most important thing is do your due diligence. Not only do your due diligence on ultimately where you're looking to purchase the replacement property, but who you're working with as a qualified intermediary. How are they holding those funds? Where are the funds being held? How long have they been in the industry? Are they bonded? Are they bonded and secured? Do they have errors and omissions insurance? Things like that you would think to ask for, especially because the role of the qualified intermediary is to be third party to you, the exchanger. So you're giving. So sometimes could be your estate or your building of wealth that you've accumulated for so many years up to somebody you don't necessarily completely know. So most importantly, asking the right questions, starting it appropriately. The earlier the better. I mean, we talk about the timing of the 1031 exchange. The IRS has allowed us 6 months or 180 days to complete the exchange transaction. But the doing your due diligence is once you're starting to think about the exchange is best as possible. Getting involved with all your respective advisors, your real estate agent, your CPA. This is a tax advantage tool. Asking those types of questions, who I should be working with as a qualified intermediary. The earlier you start the process, the better and more successful your exchange transaction is going to go. Because the first 45 days, which is known as the identification phase, so you have about a month and a half to figure out ultimately where you're going to be purchasing the replacement property. So, early, there's no rules against, figuring out and doing your due diligence in the respective markets, whether you want to be active or passive as your end goal. But ultimately, working with your respective advisors, your CPAs, your qualified intermediaries, your agents, or professionals like Tommy and Alex will ultimately lead to the success of your ultimate transaction.
Justin, and it is important, the strength, because it's unregulated, how it's structured. We all saw the Land America when things got pulled together, and others, not just them, where we all say the lake got frozen, right, with the swaps and all these things people are putting in to increase their yield, and your clients are in it. You're like, I need the money, right? And then now watching everything unwind during the last great recession was crazy. But I'm glad you brought that up, because until you've gone through it, unfortunately, or your agent is sophisticated enough to have gone through cycles, right? So not all agents, all companies, everyone is built the same. You could be in the same companies and not know this, but with experts like we have here, been around, talk to each other, show up in events, so you can give the best advice, the clear advice. Like Tommy, you said, if it's not me, find somebody else experienced, still talk to me, work, with whoever has the knowledge. And really, as like everyone said, have that expert team, with us, CPAs, lawyers, right? Just experts that we've worked with, that we could vouch for within the network, to really complete it from the very beginning to the very end, and then maybe even create multi-generational structures. It is tricky, it is not just transactional based and you're done. So that's the fun thing, exciting thing, and also with the largest transfer of wealth, right? We keep talking about it, and it is important to get there early. And I know, Tommy, when we were doing this, the minute we were going to list and sell, I was already, okay, let's get this all lined up. And that's what everyone should. So also put your information in for everyone, because they should reach out. Everyone should be ready with a Rolodex of contact information, so you can reach out and get prepped and knowledgeable, because you're going to see, and I think they said that right in the news, this is the start of the largest one group, right, of the baby boomers coming over and actually retiring. So if anyone could kind of add some advice, and I'll open up some Q&A, but Alex, maybe if you want to share some wisdom to everyone here, maybe if you're a real estate agent, how can they work with you? What can they do to contact and help kind of uplift and get their knowledge base up?
Yeah, certainly. We at Kingsbarn are one of the only sponsors that offers a California interstate program, which we're able to compensate real estate agents and real estate brokers in California, licensed in California, if we're able to compensate them if they refer an investor from California that's a resident. And we're able to pay commissions out to real estate brokers. Kingsbarn is one of the only sponsors that's able to do that within the DST industry. A lot of the other sponsors out there go through the broker-dealer channel that Tommy is in, and we do that as well. But we've also found a niche that, hey, these agents and clients are losing their investors and clients that have been with them for years and years and years. And once they go on the DST, they're no longer able to transact with them, on the latter portion of their investment horizon. So I would say, get in touch with Justin prior to a sale, to make sure that your investors are preparing for a 1031 exchange in the proper manner, so that way they don't blow their exchange. And then, work with us or Tommy, early on. You only have 45 days to identify. And that may seem like a long time, but in reality, when you're having to go through and find, the right deal and the right, location with the right, tenant, it gets hard. And so a lot of times I get involved early on in escrow, or even prior to listing. It's always a tool for real estate agents and brokers, just to get a listing in general. So, if like you had mentioned, James, do you have clients that have sold, they didn't really know what they wanted to do, or they didn't want to get into another property. They said, I've had this for years and years, and and I don't know what I'm going to exchange into. Well, I've been brought in pre-listing to help, explain what a DST is and why that may be the best option for them to sell their property, because as Tommy said, maybe it has some deferred maintenance, and they don't want to have to put the capital expenditures into the property. They would rather sell it to somebody that's looking to do that value add and exchange into something that's, passive. And so it's a great opportunity to get involved early on in the process and speak with Tommy and I and representatives like us to really understand what options are out there for your clients and for yourselves.
I'm glad you brought that up, Alex, because talking with you, some people don't know. Some places you can, get a commission. Some places you can't. Know all the rules, right? Know the UPREIT, right, for a strategy. I mean, sometimes you share it with CPA lawyers. I know, Tommy, you do a lot of discussions educating them, right? Because sometimes they don't know, because that's not what they need to do, right? They do either do taxes or laws specifically for certain things, but this is why you do listen and hear and talk to other experts. So your piece of advice, Tommy, because I know subscriptions with especially elderly people, educate them now, right? Because when they go through that paperwork, there's a lot.
Oh yeah. Yeah. Just like anything else, you have to know what you're getting yourself into, right? I mean, when you sit down with a traditional financial advisor, you go through the stocks, bonds, mutual funds, life insurance, annuities. It's an education process. It's the same thing with us. We're just building the real estate portion of somebody's portfolio. So, depending on somebody's sophistication level, I mean, I have guys that are, 30, 40-year commercial appraisers, right? And they just want the appraisal on the property, and they can do all their own due diligence on it. They don't even talk to me about the deal because they're so sophisticated. And then there's other people that need a full ground up education. So, I mean, we're happy to do either one of those. It's best if we can get in touch with people early on. I usually say at least 45 days before the sale is kind of like that sweet spot, right? But we get people that are in their exchange 42 days in, they have 3 days left to ID. So we can move as quick as somebody needs. But yeah, I mean, it's a specialty product. That's why you have to work with somebody who knows what they're doing. This stuff is complicated. The subscription documents can be over 300 pages long. You have to know how to navigate those. We're looking at those every single day. We know where everything is inside of those. We can direct people wherever they need to go. But yeah, we'll do Zooms, like we did with you, Jim. We'll jump on Zoom and go through, all the different products. We'll go through the strategy. We'll even invite on the sponsors, introduce you to them so you get to hear directly from them why they bought the property, how they bought it, why they liked it, what the investment thesis is, and all that good stuff. But, we love working with CPAs and attorneys. I mean, for any real estate brokers and agents that are on the line, I mean, those are the best referral sources for any of this stuff. I mean, hands down, CPAs, real estate attorneys, those are the best. So even for real estate professionals too, I mean, getting a really good couple CPAs in your wheelhouse that you refer business over to, that'll definitely come back to you. If you can position yourself as somebody that can assist with the 1031 exchange and you're working with a CPA that has a deep bench and understands CPA and understands 1031s really well, they're going to have clients that need this stuff. But we really pride ourselves in working with real estate brokers. We can't offer commissions to real estate brokers. I think Kingsbarn kind of cracked the code there. And, I think it's just the state of California, but, kudos to them for doing that. These are securities, so I have to break the news to real estate brokers and agents all the time that you have to have a securities license. This is a securities product. This is not direct real estate. This is not buying a strip center by yourself, fee simple property. This is a security. So it's a complicated product. That's why you have to have securities licenses to sell them. You have to be accredited investors. You have to know your client. You have to have, their best interest at heart when you're building these portfolios for them. But we work a lot with real estate brokers and helping them get listings and leads and get deals done. I get the calls all the time, like, hey, I have a client, sounds like he's perfect. I have a buyer that wants to buy his property, and he literally said, I would sell, but I'm going to have a big tax bill. I don't know what I'm going to do with the money. I don't want to pay 30 or 40% in taxes, and I'm selling for $5 million. I mean, just do the math on that. I mean, it's $1.5 million plus in taxes. That hurts, man. So that's, appreciation. That's equity that you have in the deal. That's hard-earned appreciation. Maybe you bought that property 20 plus years ago. It's like cashing out a retirement account just to get back into the stock market. A lot of the time it just doesn't make sense. But I mean, Alex brought up a good point earlier. you just go through, you see if the numbers work out, right? If you're going to get a 5% cash on cash return with a little appreciation on the back end, and you feel like you can get something better in the market, in the stock market, then maybe it's not for you. But if you run that tax equivalent yield and you go, okay, well, I'm going to sell for 5 million. I'm going to owe $1.5 million in taxes, right? I'm going to walk with $3.5 million. Can I take that $3.5 million and get the same income somewhere else, other, but instead of taking the full 5 million and getting 5% or whatever in a DST? And does it alter your quality of life? Are you in the position where you want to take on additional risk getting into the stock market? Because the stock market's risky right now, right? You don't know if it's at the bottom, the top, whatever. It's kind of going all over the place. So yeah, that's kind of what we go through with people. If the returns aren't something that somebody is looking for in a DST, maybe it's not for you. This is meant to be completely passive, so it's not meant to be a giant home run, knock it out of the park type situation. So if you're still in that time of your life where you're looking for massive returns, maybe the DST isn't for you. Maybe you still want to go out there and get your hands dirty, right? Because you can probably make more doing it yourself, but you're giving up your time. So what's your time value on that money? What's your tax equivalent yield if you were to pay the taxes? So yeah, it's what we go through with everybody. I mean, Jim, you know really well. We went through all this with you, break it all down, go through models, allocation models. It's a fun process, especially when we're working with people who know real estate really well. They really appreciate, the DST and how it's packaged and the offering material, even though it's a lot of information to digest. There's a lot of great info in there too. A lot of due diligence that you can do, market data. So it can be a really fun process with somebody who's really sophisticated, and then with somebody who's not as sophisticated. We get a lot of leads from CPAs and attorneys. It's somebody who's maybe 70 or 80 years old. Unfortunately, maybe her husband passed away, 10 years ago or whatever, and she's trying to figure out what she's going to do, with this real estate. She doesn't know what she's going to do. So with something like that, we really take our time, roll up our sleeves, and, just take it as slow as somebody needs and educate them on the whole process there.
Yeah, go ahead,
If
Alex.
you don't mind, I'd like to jump in and touch on a couple of great points that Tommy mentioned. When you were speaking, Tommy, about kind of the phase of investment cycle that an individual may be in. There's two phases that we like to say at Kingsbarn. You have your wealth generation phase. That's somebody that's hungry, getting in there and getting their hands dirty, and trying to build that wealth by finding great deals and doing the value add work. And then there's also the wealth preservation phase. That's somebody that's been through all of that, that's on the back nine of their investment career and real estate career, that's wanting to make sure that they're able to preserve the wealth that they've generated over the course of their career and pass that along to their heirs. And DSTs are a perfect opportunity for that wealth preservation phase. And the other thing that you mentioned, Tommy, was kind of the simplicity of DSTs along with the complexity, right? It's a little bit of they can be simple and they can be complex. What's complex about them is the private placement memorandum and the 300-page, full due diligence and disclosures that we have. Those are very complex to read through. And if you're not familiar at all with the PPM, best to have a great advisor that's there to work with you to understand the full ramifications of the investment. But what we like to think about DSTs is also the simplicity, because you don't have to worry about going through a lengthy 60, 90-day escrow period and having to wait to go through all the documentation and to get the surveys. All of that's done in a DST. We've already bought the property, acquired it, financed it. You don't have to worry about applying for financing. You just automatically assume the financing that this DST sponsor has put on these properties, and that gets accredited and prorated to you according to your equity investment. And so it could be closed as little as a week or so, in terms of, all right, I've done my 1031 exchange, I'm done with it because maybe their downleg's been done. They went through a grueling 60, 90-day escrow period that's been extended multiple times because of one reason or the other. A lot of times, you get fatigue and deal fatigue with these. And so a DST is a great opportunity to just jump right into the next investment after you've done your quick due diligence and review of the PPM, and complete your 1031 exchange in as little as a week. And we've done it. Fastest exchange I've done is 5 hours, if you can believe it. It was somebody that needed to get something done as quick as possible. worked with a qualified intermediary, got everything figured out, and closed within 5 hours. So it's simple in that respect as well. So sorry, I just wanted to jump in and touch on a couple of great points Tommy had mentioned.
Tommy, do you want to add something?
No, I mean, this is great, and I'll just kind of throw the hat in the ring a little bit on a couple other topics if you wanted to chat about them. But the DST is really great for a backup and boot. And then Alex brought up a really good point that we probably should touch on too, is the non-recourse debt, affiliated with DST. So I mean, a lot of people that are selling a commercial property right now for $5 million, they have a $2.5 million loan right now, because financing is one of the most powerful tools you can tap into in real estate. So a lot of people that are selling and doing an exchange have debt to replace, right? So if you sell a property for $5 million, you have a $2.5 million loan at the time of sale. The buyer's proceeds come in on the closing day, and $2.5 million of that goes into the qualified intermediary account. But the IRS says you still have to replace $5 million or more. So you can get that in the form of new debt, or you can inject cash into the deal, which goes dollar for dollar for the debt that you're going to replace. But if you don't replace the full $5 million, you're going to owe boot on whatever you don't replace, right? So it's one of the most powerful pieces of the DST, in my opinion, when you really wrap your head around that. You can go from recourse debt when you sell into something that's non-recourse debt without it going on your DTI, without you talking to the bank. And you're getting the benefit also of these sponsor companies getting way better financing and terms than we would get out in the market. So if you have clients that are thinking of selling or in the process of liquidating and they have debt, ask those questions. How much debt do you have on the property? Are you planning on doing a 1031 exchange? Are you getting a new loan because you have to replace the full amount that you sold for? It doesn't matter if you had $3 million in debt and only $2 million in equity in the deal. You're going to have to get a new loan in the amount of $3 million or inject cash into the next deal if you're doing an exchange, right? A lot of people don't know that. People call us and they're in their 45 days and they have $2 million in the exchange account. And I go, okay, well, how much did you sell for? Oh, I sold for $4 million. Okay, did you have debt at the time of sale? Yeah, I had a $2 million loan. Okay, did you know that you're going to owe taxes on that $2 million if you don't replace that? No, I didn't know that. That's huge. I mean, I can't believe that people don't know this. And that's why you got to work with people like Justin that explain this stuff out of the gates, or us, because some folks don't even know they're going to have a large tax bill if they don't replace the full amount in their sale. So the DST, if you buy into a DST that's 50% levered, right? It's a $100 million deal. 50% of that is leverage, 50% of that is equity. If you buy $1 million of a 50% levered DST, you're simultaneously purchasing $1 million in non-recourse debt, which goes to satisfying that debt boot that you're going to have as well. So really, when you wrap your head around that, it sounds a little complicated. I might have ran through that a little quick, but when you wrap your head around the power of the replacement of non-recourse debt with the DST, it's in my opinion, one of the most powerful tools and aspects or characteristics of the DST.
Justin, you want to go into it? I knew you were chomping at the bit, ready to jump in, because this is right in your territory to explain all of this.
Yeah, no, I mean, I think all of us have said start early, and and obviously do your due diligence, not on ultimately where their end goal is going, but who you're going to be working with as a qualified intermediary. I mean, just hearing Tommy's example of a client going into an exchange and not knowing the full outcome of what they're expected to be replacing is pretty wild. So which is why, choosing a qualified intermediary and working with someone who's going to educate you on that process, because, what we've been discussing here is, the forward exchange, but, there are different variants of the exchange or ways that you can combine, different parts to satisfy your ultimate goal, whether that, we've seen an uptick in the improvement exchange. So, buying maybe potential vacant land and using the excess proceeds in the exchange account to development, or improving an asset that needs some new developments on it. There's different, or doing a reverse exchange, buying first and selling later. Especially with the status of the market, we've definitely seen, and the inventory being low, we've seen clients, feel confident that, hey, I can sell within 6 months, but I don't know if I'm going to find a suitable replacement property, in the time that I'm needing to selling it. So, they want to lock things down first and then, worry about selling that, tied, relinquished property to the exchange. So working with an experienced qualified intermediary intermediary who can educate you while you're doing your diligence when you're thinking of selling a property and working out the best path forward is extremely important. And to touch on what Tommy was discussing as well, that conversation of how much debt you owe on the property, especially where interest rates are and were. I think the ability to diversify, and have your exchange go into maybe different facets of maybe a little bit here in a DST, purchase, a physical piece of property. It doesn't have to be all in one, or it doesn't have to be a one-to-one transaction. It can be one to many or many to one. And so being able to work with someone who can give you the full boat of what you can do with the exchange, it opens a lot of doors that potentially people were closed-minded to when they were thinking about doing in the exchange previously.
There is just so much, but I would say for all of us that want to be experts, you really have to know the 1031. You really do have to know the DST. And what I'm trying to do too is to find and put DSTs on, whether you want the appreciation, the yield, what's the expense ratio, all this stuff. So people know it, because it's hard. Like you said, unless you have contacts in this industry, you don't know where to go, what to look for. It's almost like, I would say, people that don't have access to tools or data, you may just look at this DST, have no idea, and boom, you get yourself into something that you didn't look at the whole, the whole global part of what DSTs and how many different ways, and even others that could help you qualify. So there is a lot to learn. And I always say, those that want to be experts, you need to, learn and show up. But Justin, do you mind sharing the event that you guys have in LA? I mean, that's where people all show up, right? To learn with Adiza, if you don't mind, for those that aren't in LA or want to show up to learn more, but it's a great place to network.
Yeah, no, I'll do a little shameless two plugs, I guess. So a little shameless plug for Alex and I. We have Education Tomorrow webinar on DSTs and 1031 exchanges. We'll go a little bit more granular on the 1031 exchange process and methods of the DST. So welcome to have you on and learn a little bit more about the exchange process and how to get that going. And then at the end of the month, there's ADISA, so the Spring ADISA conference in LA. It's a gathering of DST sponsors, financial professionals, and all alternative investments, and not just DSTs. You have the REIT sponsors, opportunity zones, so really tax advantage solutions that would focus specifically on real estate. And it's a really great place to learn about the market, the benefits of the program, how sponsors do their due diligence, what they're looking for in the future, and potentially creative ways of advancing the industry and ultimately growing it to the success that we expect it. As in its most recent year, I think in the last 2 years, equity raise has been about $5.6 billion in equity raise in the industry. And experts for the last few years now have been expecting it. And now with larger institutional players starting to get into the space, the expectation is that the industry itself will be a $10 to $15 billion equity raise over the next 5 years. So it's a growing industry. It's a growing space. It's been around for the last 100 years, and we're now starting to see the value and acceptance amongst institutional investors.
Thank you, Justin. It's good. Show up, listen event. I know Tommy does event, but yeah, for tomorrow, Justin and Alex, if you don't mind sharing for those that want to show up to learn more, to stay in contact. Also with Tommy, I know you all put your information in. Please reach out, because it is very important to understand all aspects. If you definitely want to be a professional in this industry, you should know it, and especially in residential. Also, you do have clients. It's good to find partners, people you can work with. So, you just surround yourself with experts, and that's just very important. Any questions from the audience? I know we went a little more, but it was important to kind of share all of this. If there is anything to learn, to ask. If not, I just want to thank our guests with Justin, Alex, and Tommy. And congratulations again, Tommy, on getting married and back into the saddle. So, with this group, please reach out. We've been working with them, and you can see it's a very collaborative, but another niche part of commercial real estate and real estate. You should know it, because there's many aspects, and this is just touching the surface. So if you can't show with Justin and Alex's deeper granular dive into this, please reach out and keep learning. That's the fun of life. keep learning because things keep changing. Alex, did you want to say something?
I just wanted to thank you for the opportunity to come on and be a panelist and speak again. Jim, it's always great meeting with you and you know, working alongside you as well as you, Justin, and Tommy. It's been a pleasure meeting you. I think this has been a great panel, and looking forward to future opportunities.
Perfect.
Yes, same to you, Alex. Thank you, guys. And I got to say hey to Keith and April also on here. Hey, guys. It's great to see you both. Yeah, Jim, thanks so much. Alex, great to meet you. Justin, always incredible to work with you, obviously. Appreciate all you guys.
Yeah, excited
you.
for 2025 and beyond.
Yeah.
There we go. Let's make it a great year. Thank you, everyone, for joining the Top Agent Nation Commercial Wednesdays. Join us every Wednesday for some great speakers, great events, more information. There's a lot of experts to plug in and work with each other. That's the fun thing about real estate, right? Finding the team to collaborate with. So everyone have a great day, and look forward to seeing everyone again next week. Thank you so much, everyone.
Absolutely.
Bye-bye.
Thanks, guys.
Thank you all, and see you soon, Paul. Looking forward to it next week.
Hello.
Bye.